Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. In this video, we're going to be talking about the S&P 500. I have a very interesting and intriguing chart to show you guys in this video that's hopefully going to put everything we've seen until now into additional perspective. This is a very wild market environment that's definitely weighing on investors' minds. We've seen the largest drawdown in the stock market since COVID-19, plunging the S&P 500 into bear market territory according to CNBC. But that's not going to be the focus of this video. We have a lot more interesting things to talk about. We're going to talk about what kind of economic downturn the market has already priced in. Could it price in even worse conditions? What would happen to the stock market if that were to occur? If you're interested in following these crazy markets with us, do not forget to smash that subscribe button. Also, if you enjoy this video, don't forget to click on that like button. Now, without further ado, let's get right into it. Okay, so this is the first chart that I want to show you guys. This is the S&P 500 on a yearly percentage change. That's the line in red, and the line in blue is the manufacturing PMI. So you can think of this as basically a good measure of economic activity. And you can see here on this chart, the relationship that these two have is absolutely astounding. The S&P 500's performance on a year-on-year percentage change is basically just what the PMI is doing. And you can see that was the case, for example, in the 2000 bear market, on the recovery from that, in the 2008 financial crisis, throughout the entire bull run that we've had since 2010. They track each other. They always come back to each other. They always seem to come back to each other, which is incredibly interesting. So how can we take advantage of this? How can we actually use this as useful information? And the way I like to look at this, and the way I look at pretty much anything, is whether there is a divergence and something that's not happening in the way that typically things occur. Are things being extrapolated? Is the market extrapolating and assuming that some things are going to happen which may not really materialize? And you can see, for example, I'm going to quickly go over a few examples so that you get the hang of it. Here back in 1999, S&P 500 yearly percentage change was almost near 50%, right? So the market had climbed an astounding 50% in 1999 relative to 1998. And this was right as the PMI was declining in a significant way. So that was telling you the market was way too optimistic relative to what economic growth was telling you about the underlying economy. And here you can see towards the end of this bear market, if you know your stock market history, 2000 to 2002 was a horrible moment to be in the stock market. And you can see economic activity recovered very sharply in 2002. And yet the stock market up until 2003 remained incredibly low. So the stock market was low relative to the economic activity, telling you there was an opportunity. And in fact, that was probably one of the best buying opportunities we had seen in decades. So that's the quick concept behind how we like to look at this. Now here you can take a look at this. The S&P 500, this is the S&P 500 year-on-year percentage change in June, right? And you can see where this is. We're around 10% into negative territory, 10% here relative to June 2021. And we can take a look if that's true here. Where was June 2021? It was around in this period here. Let's measure where we are. Currently, we're around 12% below that zone where we were trading in back in June. And you can see what that means for PMIs. It means the market is pricing in that PMIs are going to be at around 48. So a significant economic slowdown that takes us very close to recession levels. So there's nothing wrong with that, right? That's absolutely fine. But you can see there's a big gap here, right? There's a big gap, and according to this chart, even when you have big gaps like this, PMIs and stock market returns tend to converge and become aligned again. So let's paint a couple of scenarios here and say that in December 2022, so this blue line I'm drawing, I apologize for how bad this line looks, but let's put a hypothetical deadline here for when these two lines need to meet. So let's first take a look at the stock market and take a look at 3 different scenarios for what might happen between now and January 2023. And hopefully this is going to help us have an additional piece of information to have an end of year target for the S&P 500. Now, of course, predicting the market is a lot more complex than that. Let's walk through this hypothetical, very simple exercise. First scenario, we get back to the all-time high. Right here, January 2023, the market has rallied an astounding 30% from current levels, massive upside, and is back to its all-time high from January 2022. Second scenario, right here, we trade sideways. We don't do anything for 6 months, and in January 2023, we're at the same exact level as we are now. So a type of sideways trading range where nothing happens in the market. And the final scenario, catastrophic performance, 3,000 points is hit on the S&P 500. We're back to these levels here, strong support. Lots of people out there discussing 3,000 points as a potential scenario for the S&P. So let's take that scenario into account as well. So how do we figure out what this chart is going to look like? This is year-on-year percentage change on the S&P 500. So let's call this scenario 1, scenario 2, and scenario 3. Scenario 1, we get back to the all-time high, and that means that the stock market has been flat since January 2021. That's a 0% year-on-year change in scenario 1. In scenario 2, from January 2022 to January 2023, that's a 24% move down in the market, so minus 24. Then scenario 3, from January 2022 to January 2023, that's an almost 40% drop on the S&P. So let's put 40% here. So in those scenarios, assuming that the red and the blue line join forces, where does the PMI need to go in those 3 scenarios? So I'm going to put a few blue dots here so that you see where the PMI needs to go by December 2022 in those 3 scenarios. And this is the result. This is scenario 1, this is scenario 2, and this is scenario number 3. If the stock market gets back to the all-time high by December 2022, that means it's priced in a PMI that goes down to 50, which you can see would be a typical move to see. Now, if we trade sideways from now until December 2022, that would mean PMIs have declined into a severe recession territory. So that already puts a lot of perspective around where we currently are in the market. We always say that the market is always looking around 6 months ahead. So this is telling you that if the market essentially does nothing and doesn't price in anything else, the economy should be in a deep recession by December 2022. I am not saying that's impossible. I am just merely stating what has been priced in by the market right now. Now, if by December 2022, so 6 months from now, we end up seeing this massive collapse of the PMI that immediately takes us into 2008 recession levels, to the same levels of economic activity that we saw at the height of the 2008 financial crisis, we would need to see the market drop another 20% from current levels. So that is what's priced in by the market, according to that chart of the PMI. Those are the 3 scenarios and what needs to happen to economic activity to justify all-time high, flat, or a 20% drop on the S&P 500. Now, the goal of this video so far has not been to predict anything. It's just to show you what's been priced in by the market so far. Now, in my opinion, and I know this is a controversial opinion right now, but in my opinion, it makes reaching the all-time high on the S&P seem like a lot less of an impossible scenario if you take into account the fact that the market has already priced in a drop of the PMI back down to 50. If you add on top of this increasing optimism regarding inflation that's coming down, bond yields that are coming down, perhaps later down the road even a Fed pivot, which is not impossible in the next 6 months. They've already talked about pausing in September and reassessing and staying nimble. Perhaps this chart here could almost morph into what happened right here, where the market was pricing in terrible economic activity. But as the market environment changed, it started to price in a lot of optimism. And this is where really you should have been coming out of the market in an aggressive way, as the market was being much too optimistic about economic activity when the PMI was still very much struggling here. Macro can take time to reverse. It can happen very quickly, but it can also take a lot of time. This is what's been bringing down the market again and again. Investors are waiting for inflation to peak, right? The big headwind to the stock market, the reason behind all the pessimism, it's been inflation. It's been elevated rates of inflation that's forcing the Federal Reserve's hand. When you start to see signs of disinflation, inflation numbers coming back down, we expect that to change the entire macro environment. And that's something that we'll have to find out. But the point is that disinflation is taking a long time to materialize. And this is leading the market into levels, oversold levels, that I would have never expected a few months ago. Now, from a short-term standpoint, I think it's wise to say we can't make any more assumptions. Stocks are at oversold levels not seen since the pandemic, but this is not a timing indicator. You could always see more oversold before the rally plays out. And to us, if we do get an additional capitulation down to 3,500 points around these support levels, which is another 5% under current levels, that would be an even more attractive risk reward for the macro setup that we're currently taking a look at. Now, all of this is going to be made incredibly clear in the complete revamp of the website and our service that we're currently making. The goal of the service is to strive to keep you guys ahead of the market and to identify the opportunities when the risk reward is there. And not just in short-term tactical bets, but actual strategic investments that are going to be represented in a model portfolio. This type of macro bet, where you have a significant shift in the macro environment that leads to a recovery from very oversold readings, that's the type of thing that you need to prepare in advance. I see a lot of people saying, I'm just going to wait until things improve to get back into the market. By the time the individual investor realizes that the macro environment has improved, the market is already 10, 15, 20% higher from that oversold level. So that's just how we like to play the market. We like to lean in on these massively oversold readings and position accordingly before you get that massive recovery. And in fact, in this article that we posted last week, we highlighted our favorite sectors for the recovery, taking a look at historical episodes of disinflation and what the top performing sectors are in that type of environment to really maximize the risk reward. And in fact, these are sectors that have been completely beat up in this correction and that are currently at ridiculous valuations. Those are the types of investments that we're going to be including in the model portfolio when we do the complete redesign of the website. All members that have already signed up to the website will keep their original pricing to the website. We do this to honor the people who have stuck with us since the beginning. We still have members on the website that are signed up for $19 a month, which is just absolutely ridiculous for what the service has become. So if you are interested in following us in this crazy journey, make sure to click on the link down below and go to gameoftrades.net. Also, if you enjoyed this episode, don't forget to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.